Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
2024 may be coming to an end, but I want to talk to you one more time about our friends at YCharts. If you're a financial advisor, you know that time is one of your most valuable assets. Between prepping for client meetings, creating proposals, staying on top of market trends, and managing portfolios, your days are packed. That's why the tools you rely on have to work seamlessly, and YCharts Quick Extract does exactly that. Quick Extract is the ultimate time saver for portfolio analysis. It lets you upload client portfolios in nearly any format, PDFs, spreadsheets, screenshots. That's amazing. So you can skip the hours of manual data entry and dive straight into analysis. In just seconds, Quick Extract sets you up to focus on what matters most: high-impact tasks, building client relationships, and driving AUM growth. If you're ready to see how Quick Extract can transform your practice, click on the link in the show notes to learn more and get 20% off your initial YCharts professional subscription when you start your free YCharts trial if you're a new customer. Where else are you going to find information about shareholder yield? Go sign up today and tell them that Meb sent you. Welcome, everybody. Another awesome episode today. The Christmas markets are out. We got our guest, Matthias Hanauer. He's researcher on Robeco's Quant equity research team. His areas of expertise include international factor premia, stock selection research. Today, we're going to talk all about factors in the setup for one of my favorites, value. Today, Matthias, welcome to the show.
Thank you, Meb. Thank you for the invitation. It's a pleasure being here.
We've probably featured more Robeco pieces and pieces of yours in the best investment writing, in the idea farm, over the past year or two than just about anybody. So kudos to the amazing work you guys have put out. I think I said at one point that your piece about the top 10 charts about value, the reports of my death have been greatly exaggerated, was probably my favorite chart book of the year. You guys did this in January. And like the investment gods, they love to laugh at all of us. And of course, and I think the S&P, as we're recording this, is, who knows, up 25% again this year. Walk us through this post. So what are you guys talking about here? And kind of maybe talk about some of the charts in your head, and we'll interlace them in the YouTube video for listeners who are doing this on the podcast, as well as in the show notes. Talk to us. What's the setup?
This post started several years ago in 2020, when we were really in the mid of the value crisis, the quant winter, when a lot of people said like value investing is dead, it doesn't work anymore just because the realized returns have been really, really bad. And then we decided to write a piece on it, explaining how we see value, that it's not only book to market for the time series that French has on his website, but also that maybe there are other metrics that you can look at value investing, and also some more risk management, like saying making industry neutrality for value investing, these kind of things. And we started writing it down in a paper with David Blitz, where we said resurrecting the value premium. And actually, funnily, more or less put it on SSIN when this value factor had really its low in 2020. And then the first graph shows this long-term performance starting in 86 through the beginning of 24. And really, we posted this graph at the low, and afterwards we see a nice resurrection of the value factor out of sample. And this is just like the long-term evidence. We also see that there's a major drawdown, not only in 2000 in the buildup of the dot-com bubble, but also over this period, 2018, 2020.
And so when you guys say value, what does that mean for you? You talk about things like the enhanced value factor.
Yes, you're right. It's not about just one single dimension. We look at several dimensions of valuation. So we always have a fundamental value divided by the price. And the first one is actually book to price, but not the simple book to price as Pharma and French have it. But we also take some of the investments or the costs, like investments in intangibles, we capitalize them. So it leads then to higher book values for firms that are research intensive. But we also mix it, blend it with other signals such as EBITDA to EV, that's quite popular in the private equity world, or cash flow to price, looking at different financial statement next to the balance sheet and income statement. And also something that we call net payout yield, that is dividend yield plus net share issuance. So similar what you call, I would say, a shareholder yield.
Walk us through what it's saying right now, or what it's been saying for the past few years. So you've had, obviously, everyone knows values worked for a really long time. You had this bad period, potentially bottoming out at the craziness at the end of 2020, 2021 start. But people look around and they're like, yeah, but Meb, the S&P's up 25% this year, 30%, whatever it is by the time this publishes. You guys just don't get it. What's it been saying the last couple of years, and what does that mean going forward?
Well, value stocks, by this definition, are cheaper than growth stocks, but there's some variation over time. And what you see in the second chart of this post was, that the valuation of value stocks, when you look at something like the forward PE ratio, that was around 8 to 10 on average. And for the expensive stocks based on this definition, they were also having valuations of forward PEs of 20 around on average. But there were episodes in the time where really this number went up to 30, 40, 50. And that we have seen during this quant winter. And this explains why value stocks were underperforming, because the expensive stocks were getting even more expensive. And when you divide these two time series, you get something like the value spread. And we saw that the value spread was like 2-3 times higher than it used to be. And to clarify one thing, this is like the difference between the average value stock and the average growth stocks. So even like last year, for instance, and also partly this year, it is that the average value stock was doing similar or better than the average growth stock. But there were like these big tech stocks that are really dominating the S&P, like Nvidia, Amazon, Tesla, these kind of stocks, that they are not in the typical value portfolio, but they were outperforming the rest of the S&P 500, and therefore maybe the typical value strategy not having in this stock were also underperforming the S&P. But it was not that value itself as a factor was not working. It was more that like size as a factor was not working.
And you guys are analyzing this globally, correct? Because like a lot of times, I mean, I'm looking at figure 3, which is the valuation spread for value. And so often when you think back to the US charts, you think, hey, you have the Mount Everest is 1999, 2000, and then maybe 2020, 2021 might be Aconcagua or McKinley, one of these other mountains. But in this case, the valuation spread is even wider during the period. Give us a walkthrough on that. Is that largely due to foreign and emerging, or what's the influence there?
No, I think difference is not that it is like in the US less pronounced than in the other markets. I think one of the enhancement, what we have for this enhanced value factor is that it's also region sector neutral. So we don't compare the utility stock in Japan with the tech stock in the US. So we try to compare apple to apples. And I think what we have seen during the dot-com bubble was that certain sectors were also outperforming other sectors like telecom, media, technology. So there were more sector effects. But what was different in 2018 to 2020 was that also within each of the sector, the more expensive ones were outperforming the cheaper ones until November 2020. And then we saw a strong comeback of the value stocks also across or within each sector. And it was less a sector allocation thing, but more really a selection within sectors. I think this explains this difference. We can run the same chart without these region sector neutralities. Then I would expect that these two peaks would be more at the same height.
A lot of people say, great, we know this. You could have told me this last couple of years. What does this mean going forward? The fourth chart is value returns versus value spreads. And that looks like a Quant would say, a nice regression. You got a nice R squared on this. Where do we kind of stand today? And what does that mean going forward?
So what you show here is actually that the realized value returns that are on the y-axis mainly explained by the changes in the value spread. Yeah? So half of the variation is explained by it. And when you look at the intercept of these lines, so where the dotted line crosses the y-axis, so this is about 10%. And this 10% is even higher than the realized value return over the whole sample period. And this can be explained that the starting valuation for value was more normal than it's still now. So the spread came back recently over the last 3 years, but it's still higher than on average. And if you think that the value spread will normalize, so converge to the historical average, then I think this would be further tailwind for the value factor. But even if you say there are reasons that these valuations structurally stay at this higher levels, the difference, then I think it's still the structural value premium coming from, let's say, the migration of cheap stocks going into value portfolios when they become more expensive, dropping out, the carry component, the higher dividend yield, these kind of things, that still this part you should expect to stay high. But it can also be, of course, if the valuation spread widens again, that we have weaker years for value coming in the next years.
Listeners, I always liken this, you can look at this on markets in general too, where you have these very long regimes where you may have, say, the whole entire US stock market. Think back to 2009, looking at something like the CAPE ratio was trading in the low teens and today in the high 30s. And this multiple expansion is a huge tailwind of performance additive to what's just going on with the rest of the market. And the opposite is true as well. If you go back to 1999 and we're at 44 and then ending in 2009, low teens, that's a huge headwind. And so it's the same thing with factors, right? Where you get these value spreads can be a tailwind or a headwind as well. So what's this saying going forward?
So it's hard to predict where the valuation spread is going, but I think it is more helpful for understanding what is happening, because back then in 2020, people were really asking, is there a reason why it stopped working? It could be that expensive companies had then really higher realized growth than less expensive companies. So there was a reason that this value premium was gone away, but actually as the spread widened, something like fundamental performance was not really explaining it, or let's say that over the last 20 years, value was getting crowded so that value stocks are less cheap than they used to be and growth stocks less expensive. So actually, this is the opposite what we see. So this is more for us helping to stick to value in this case, not giving up, because we saw the explanation where it was coming from. I think it's really hard to say where the spread is going. I would say a rational assumption would be that the value spread stays where it is currently, and then you would expect like a premium that is close to the historical average.
A lot of people always say, what about interest rates, interest rates, interest rates? Value does better when blank. What'd you guys find? What do you think?
I think this was really a very popular explanation in 2020 and 21 when a lot of people said, yeah, all these growth stocks, they have longer duration because a lot of their future earnings will be 10, 20 years in the future. And these value stocks, they have now the high dividend yield. So they have a lower duration, and therefore growth stocks profit when rates are lower. So they are getting discounted with a lower rate. And we actually saw this pattern really during 2018, 2020. So when the treasury yield was going up, value stocks were doing better. But when treasury yields were going down, growth stocks were outperforming. But when you really look at the long-term evidence, this is like all the blue dots, like it's all the evidence from 86 to 2017, there is hardly any relationship between changes in interest rates and value returns. And also in the period after 2020, you see little relationship. So there was some correlation during this time. I think maybe it was also a bit self-fulfilling at a certain moment, but I think there's no long-term structural relationship between interest rates and value returns. And if people have an opinion in which direction interest rates should go, they shouldn't play this via value versus growth, but they should play this via other instruments that are directly playing on this move.
Yeah, I think that's a take that is probably a lot of people might disagree with. I like it. I think it's accurate. I think it's one of those traditional examples of sounds good when you describe how interest rates might affect certain types of companies, but I think it gets a lot more complicated once you start to look at the data too. And then you have different regimes as well. And then you have different, not just interest rates, but relation to inflation at various points in the cycle. A lot harder, I think, than most people make it simplistic. One of the things that everyone is listening is probably say, yeah, but again, growth growth, growth, growth. Your chart 7, I think, is a pretty, and it kind of dovetails with chart 9. It's all been about the Mag 7 type of companies, the big companies, the growth companies. What have you guys found with sort of expectations? I mean, looking at some of these companies today, Palantir, and doing the old Malbison thought experiment where you work backwards from their valuation and try to come up with what sort of growth they need just to reach these sort of multiples. What did you guys find with this kind of growth stock concept?
Well, there's always a reason why certain stocks are more expensive than the others, and usually they have better prospects, a better outlook, also had maybe a better growth historically. And what this shows is the past and expected growth for value stocks that are the blue lines and growth stocks that are in red lines. And the solid lines, they show the past realized growth in ROE, and the dashed lines, they show the forward-looking growth expectation from analysts. And you see that at the moment you form these value versus growth portfolios, the growth stocks had like a 3% higher growth historically and also expected versus the market, and value stocks had lower expected and realized past growth. But the longer you hold these stocks, so we keep the sample fixed and just wait 1, 2, 3, 4 years, and you see that over time these expectations converge as also the realized growth rates converge. So if you compare the solid line at month 60, so this is the realized turns or growth over the last 5 years, with the expectation, so this is the dashed line, you typically see that the realized growth is lower than the initially expected growth. And I think this is the key reason for the value premium, and not interest rate sensitivity or these kind of things.
Within this wrapper, everyone talking about value, there's also this reality that US is creamed, foreign, and emerging as well. And so looking at this emerging markets versus world, talk to us about figure 10, what this means.
The blue line shows the relative performance of the MSCI World versus the MSCI Emerging Markets. So if the line goes up, emerging markets are outperforming. If the line goes down, the developed markets are outperforming. What you see, this relative performance is volatile. Starting at the 2000, emerging markets were outperforming until 2010. But for the last 10 to 15 years, the MSCI World, so developed markets, were outperforming mainly due to very strong US markets. And you can say they have been realizing higher growth, they have higher earnings growth, what is partly true. But also the valuation component plays a big role. So when you look at the orange line, so this is like the value spread for emerging versus developed markets. And you see that these two lines really move nearly parallel. And I think if you look at 1 year changes in the two things, then the valuation changes explain about 75% of the relative performance. So this indicates the big part of the relative performance is not explained by fundamentals, but it's more explained by valuation changes. And I think these are less sustainable in the long run than fundamental differences. So if you expect, of course, that developed markets will stay similar expensive compared to emerging markets, then maybe we don't see any relative outperformance of emerging markets versus developed markets. Or if you even think that they even become more expensive, then emerging markets are supposed maybe to underperform further. But if you think that these valuation differentials convert more towards the historical norms, then we would expect that emerging markets actually are outperforming developed markets. And I think earlier this year we have seen this partly, but with the last weeks, with the elections in the US, I think we have seen a bit developed markets again outperforming emerging markets.
We just had this election in the United States, and you had this massive value jump on the week, days after. What do you say to people when you try to say, hey, has this inflected? Or what do you think about the predictability of how this might play out? Do you have any good suggestions for the listeners out there?
I can only guess here, but I think one catalyst be now the market is really optimistic to all things related to AI. I think they see it as a growth opportunity, saving costs, having higher revenues. But it also means that companies do a lot of AI. They also have invested a lot. So if this perception at a certain point changes, that people more focus of the challenges than the opportunities of AI, that might be something where a turning point for the big tech stocks, for instance. And I think it's also that maybe we see some more really fundamental growth, earnings growth in markets outside the US that could then also trigger a comeback of emerging markets, Europe versus the US, for instance.
We often try to describe to listeners it's not always a binary, hey, value versus growth type of decisions. There's usually a lot of overlapping Venn diagrams. So, for example, if you look at something like emerging or foreign, they may have more value opportunities, or something that I want to lead into now is size. People would say, well, small caps versus large cap. And there happens to be, I think, probably a decent amount of overlap with what we're talking about now. You wrote recently at the end of June, you're like, the value spread between small and large caps at levels not seen in over 20 years, offering a multi-decade opportunity for investors. So let's talk about that.
I think if you look at it, I think DM versus EM and large versus small cap show a lot of similar patterns. I think there's relative performance. There are cycles. I think there have been cycles where small caps have been outperforming large caps. I think if in the long run we see an outperformance of small caps, we are a bit critical on size as a standalone factor, because if you control for the higher risk, then size itself, it's not a factor standalone. It does not mean that you shouldn't have small caps in your portfolio. I think my starting point is that you should hold the market portfolio, and an allocation of 10 to 15%, depends a bit on how you define small cap, should be like in your strategic asset allocation. And then there are maybe technical opportunities that you can say, because of the current valuation, I want to overweight small caps. And I think this is what we pointing to in this insight that you just mentioned. Because of the underperformance of the last 10 to 15 years of small caps versus large caps, we see a big part of that is driven by valuation changes. And this might be an opportunity that small caps might come back for the next 10 years. And then is, of course, as you said, it's not binary. It also depends a bit how to do small caps. I think small caps, you have a really big breadth. You have a lot of dispersion in stocks. You have a lot of unprofitable stocks, but you also have several profitable stocks, and with good quality, low valuation, low risk. And actually there, the playing field is much bigger than in large cap space. So factors also work in the large cap space, but typically what you see is that factor premium are higher in the small cap space.
It's interesting because you look at sort of known truths that have been in our industry for decades. And so when I came up, I feel like most people talked about small caps almost like a totally separate factor, where you saw the long-term Ibbotson chart, or maybe it was in stocks for the long run, I don't know. And it was like bills, bonds, stocks, and then small cap. And small cap was like outperformed everything. And if you were a risky young investor, you wanted to put a lot of money in small caps. But I feel like the general vibe and understanding is that it's not really a unique factor in the sense that it's like alpha that you can magically get, but rather, as you mentioned, it's somewhat of a riskier allocation, and people don't think that small caps magically outperform. I feel like that's now the common take on it. So I feel like this is a good lead into the factor zoo. I think a struggle with so many investors is they go to the grocery store and it's just a limitless amount of cereals you can buy. It's like factors. It's like, where do I even begin? Can I just choose between Cheerios and grape nuts? And not only that, it's harder because the store also says you can mix Cheerios and grape nuts and Fruit Loops. So it's not just one factor, it's 100. And so you guys had a paper called The Factor Zoo. Maybe tell us top level abstract kind of what this paper was about, and then we can kind of dive in on some of the topics too.
Yeah, you're absolutely right. You can think about it as a grocery shop. Maybe it's more a candy shop where you can find a lot of sweet stuff. And in the academic literature, there are like more than 150, maybe 200, 300 reported factors or signals that claim to explain the cross-section of stock returns. And I think this is in a big contrast to like academic factor models on the other side that have a handful of factors, like the Farmer French 5 factor model or other models. So the question was really, is it 150? Is it 5? Or is it something in between? What we did in this paper is we examined how many factors it really needs to explain this zoo of 150 factors that we had in the data set. And turned out that 15 factors were enough to explain all of the available alpha of this vector zoo. So it's something between the 5 factors of the common academic asset pricing models were not enough, but it's also not 150 independent factors because there was a lot of overlap. Several momentum factors, several value factors, several factors measuring earnings quality, these kind of things. And typically then you pick only one of 2 out of these categories.
Imagine how many times you've been asked this question, but I guarantee listeners are thinking in their head, what were the best ones? I understand that it is total data mining, but I still want to know, what were the best ones?
The best one turned out to be cash-based operating profitability. And this is like an enhanced profitability factor of the Fama-French 5-factor model. So it looks at top-line profitability, so not bottom line like ROE, but more something close to gross profits. And then translates it into a cash-based version. So you get all kindly the earnings quality accruals factor blended in. And so this is a factor that is quite persistent, so easy to train. You don't have a lot of turnover. And the nice thing, it nicely diversifies with value because typically these stocks with higher profitability are also more expensive. And it's not too related to other factors like momentum. So it's really another dimension of stock returns. And then I think the next factors on the list were like also fundamental factors related to accruals, earnings quality, but also valuation and momentum. And what was very interesting there was that residual momentum was picked up as one of the first momentum factors. That is a factor that was discovered by my colleagues in a paper in 2013.
How should investors think about putting the factor zoo together?
I think I would start really asking yourself, what are my beliefs? In which type of concepts do I believe? Is it valuation? Is it momentum? Do I think that there is added value in, like, say, analyzing balance sheet and income statements? And then maybe you have your first categories that you want to start with, say, value, momentum, quality, something like short term, depending a bit on your trading possibility. If you have higher turnover, you can also blend in more short-term factors like short-term momentum, short-term reversal, or seasonalities. And then maybe you pick one definition that you find most reasonable. Maybe you find academic evidence. And then you have a running model. And then it's a bit about launch and iterate. Then maybe you start fine-tuning. You do some research. Can I enhance my value definition? Can I broaden it a bit? Maybe you don't want to rely on one single definition, but you want to have 2 or 3 signals measuring that concept, like valuation, doing the same on momentum and quality and so on. Depends a bit how much capacity you have in your team. Fine-tuning these factor definitions, enhancing them, or finding new categories that add orthogonal alpha to your process. And this is, for instance, also what we see in this paper is that when you start the analysis in the 80s, when only with these factors that were published up to this point, then you were choosing other factors than the 15 that we find in the end. And then you see gradually over time, when adding more and more factors, that newly published factors then come in and older factors drop out. Some old ones also stay in. But this is also like the evolution in the factors, so you can think about that. And this is also what we try at Robeco. We continuously try to enhance our models. Researching, can we take out unrewarded risk? Can we find new alpha sources? This is what we are doing.
If you look at a lot of the American multi-factor funds, or you pick a stock that screens well across a lot of the traditional Chicago PhD metrics, and you type that stock into any of the online sites. I used to say Yahoo Finance, but anyone, Y-Charts, probably my favorite now. And so you type in some of these stocks, and then it's just a laundry list of the same large quant shops in the US. It'll be LSV or AQR or Vanguard, depending on who's doing the factor things. And so really, you either need to come up with factors that are somewhat timeless or new or different, meaning, hey, don't be like Matthias and publish. Keep it to yourself. Maybe it's a super secret factor. But we're entering this new age, which I think is a good segue into kind of this next topic on what you guys have been writing about a lot, which is a little more modern, talking about machine learning, talking about AI, how to incorporate sort of new processes into what it is you're doing. So maybe walk us through what you guys have been writing about here with machine learning?
AI is also a big topic for us, of course, and you can maybe say AI is a big topic, and parts of it is like machine learning, more statistical learning. Other things are like natural language processing, where you analyze unstructured data such as text and translate it into numbers that you can use them later for your quant models. But one avenue that we were going was machine learning, and I think this is more an enhancement to like the previous process where you combine factors in a linear way. When you do machine learning, you can also start with a very simple OLS model. Then you say, okay, instead of choosing the factor weights by hand, I let the data speak, and my OLS model says, okay, this weight goes to this value signal, this weight goes to this momentum signal, and so on. So that you're a bit more data driven. But the more complex models can also capture things like nonlinearities and interactions in the data, and are there a way to enhance a bit the performance of your models? Because you can also identify nonlinearities and interactions manually and just plug and play them to the model. But I think the model has much more freedom to discover these interactions and nonlinearities. And I think we have been writing some papers in this area. We find that also these machine learning models are not immune to like performance decay. So you see that in the US, a lot of the traditional factors had a low performance after publication, after 2004, where there is maybe more liquidity in the market. Interestingly, the same factors don't show this decay internationally. So this is another reason why you maybe should think about investing internationally, because factor decay seems to be the lesser concern than in the US. But also we have been looking critically at machine learning strategies, because there are a lot of design choices in these papers that have to be made, and there's not like a clear consensus what you can do. So for instance, some of the papers do rolling windows versus expanding windows when they're fitting the models. What do you explain? Is it the return of a stock over the risk-free rate, or should it be better the return across over the market? If you're interested in relative returns, I think this might make more sense to do like a pre-feature selection, these kind of things. And what we found out in this fresh paper is that when you permutate over all these design choices, you get 1,000 models that are all fed with the same data, evaluated in the same way. And what was quite astonishing was that the worst models over like 50 years out of sample period have a average return of 0% nearly, and the best models have returns close to 2% per month. So this is all before transaction costs. But I think this shows an immense dispersion in returns, and that people should focus at design choices, explaining their choices, why they do it, and have a clear economic reason why they do that.
I think people probably perked up when you said 2%, assuming you were going to say per year, and then you said per month. And so when you see the output of some of these, how often do you have to mentally or physically constrain what's happening? Because you're like, oh, hold on, this is crazy output, or this is actually really interesting. Wow, we just found this brilliant new insight that no one knows about. So let's do it. How do you kind of balance that sort of real world application with what it's spitting out?
I think this 2% is a really high number, but this is really the best out of 1,000 machine learning models. So would have realized this return before transaction costs if you would have picked out of these 1,000 design choices, particularly this best one. And this, I think, is highly unlikely. And I think you shouldn't then also, when showing to your clients or prospect like a backtest, you shouldn't pick then this one single best backtest, but maybe say, okay, we know this played out very well in the past, but maybe it might be a bit biased. We just diversify over different design choices. This gives maybe a more robust and a more realistic expectation for the future outperformance of the strategy. But on the other hand, you also have to think about it. Okay, which design choices really make sense? If I have a model that has to estimate a lot of parameters because it can capture more complex relationships, nonlinearities, interactions, then you need a lot of parameters that you want to estimate. And then it might make more sense to have an expanding window than a rolling window. And we see in this paper that some of these design choices really give a significant, structurally higher return, and others make maybe less sense.
And so how do you balance that as far as like if you're going to implement it where you're like letting the model run wild? It's like I think to the early days of looking at whether it's machine learning or AI applications where people look at it and we're like, these moves, like it's not even something someone would consider. And then once you start to go through it, you say, okay, well, actually, this does make sense. Or on the flip side, in our world, there's so much with perception. And I think the classic example I love to talk about, we say you can't look too different. And so when we talk about something like even trend following, and you run a traditional trend following simulation through the various optimizers, almost always it kicks up a large allocation to trend following, yet no one is willing to do that allocation, right? They say, oh, no, we got to constrain the model. That's crazy. So how do you think about actually implementation? Do you have some strategies where you're like, let's just let this run hog wild? Or do you guys kind of take the output and say, okay, let's put our PhD sort of real world street smarts on top of this and figure out something that's actually palatable that someone might want to invest in?
So I think there's where really a strong research protocol kicks in. I think we start feeding the model with features where we think they economically make sense. And then also in the terms of design choices before testing all available options. So we did this in this research papers with two students from Technical University of Munich, but this is not how we did it at Robeco. So really pick design choices initially where we really think this makes sense from an economic perspective. And then we run the models, backtest them, but then usually we blend the different models, ensemble them. On one side, we see that ensembling is like diversification in machine learning, that is the free lunch. But also we won't just pick the best model historically because we are unsure if this model is also the best model out of sample. It's similar, like we won't take one momentum definition that is maybe the best one historically for this sample and just pick them. We also have there several signals measuring it, similar with value. And this same philosophy also holds for these more advanced techniques.
Fun. So before we skip off from machine learning, any final thoughts on this topic about what you guys are working on, or what can we expect to see coming from you guys in the coming months?
So, well, machine learning is one area. As I said before, this is more an enhancement of these more linear ways of combining factors for me. I think we can maybe find more orthogonal information, unstructured data. It might be text data where we can, with the help of NLP, get some new information out of it. It can also even be the next level from text, maybe voice or maybe videos, like seeing the faces of the CEOs and CFO in earnings calls, how they react to a question of an analyst, for instance. So this could be something very interesting to look at. And also all kind of alternative data. So there's so much alternative data around. We're looking at various sources. It's always a bit of a challenge because some hot data, you don't have the long history to backtest. And then you have maybe a clear economic idea why this should work. And what we usually also really like is that we have a lot of control how to combine the data. We don't like if a lot of signals are already pre-processed because we don't know what was like optimized under the hood from this data provider. So we like to have the raw data and do it then ourselves, the final signal.
As we wind down 2024, give us a preview. What else is on your brain? What else are you thinking about? Are we just going to be doing this annual value update for forever? Anything else that Matthias is working on that he can give us the preview to for the future?
So the thing is, I like to doing this value updates, but there's a lot of more than value that we do at Robeco and what I do. So, but it was very popular by the people. So probably I will do some update because just people want to see it. But we are not just value, we are also momentum, quality, and a lot of other proprietary signals that we developed over the last 20 years. But probably at some point I will do an update again.
And momentum, you're speaking to my heart. We're almost like at the back end of the podcast, and momentum finally comes up. One of my favorite metrics. Are you guys still on board with that one? Is that still in the quiver?
Yeah, so we have several ways how we measure momentum. It can be the pure price momentum that was working really well the last years, but you always have also the situations like in 2009 or in the 1930s where it often happens after a bear market when the market turns that you have these momentum crashes. Of course, these ones you want really to avoid, and we found some techniques to limit these crashes, giving up only a small part of the premium. And if you think about momentum as a concept, then maybe you think there is credible information spillovers, then you may also want to look into other sources where you can play momentum, being it news, price momentum from other markets that you can exploit. So it's just more than a pure price momentum strategy.
I like it. One of our favorites forever, I think. All right, so give us a preview. What else are you working on? What's on your brain as we close out the year?
The continuation of what we have done over the last years. I think Robeco was known really as a classical quant shop with value, momentum, quality. But over the last years, we have been really going into like machine learning, NLP, alternative data. And I think we want to go into this direction more. We spend a lot of time investing in our infrastructure, building pipelines that we want to leverage. And now it's much more efficient analyzing these potential signals. We're also thinking about more contextual models. Do we want to have the same models for all stocks, or do we want to have some more regional or industry models? So this is one way. We want to go into more faster models. So we have already a lot of short-term signals, but can we even go faster? And then maybe also not for the existing products, but also having products that are faster than our existing ones. These are directions that we're looking, but also enhancing the existing classical factors like value, momentum, quality.
What's something that you would say that most of us would disagree with? It doesn't have to be me because I'm crazy, but you sit down a group of your friends at the conference room table. What's something that you would say that most of your professional friends would not agree with you on?
I think we started the podcast with like how to define value. And I think a lot of people in the quant investment world, maybe also fundamental investors, they say like, yeah, there's various ways to define value, but they probably say book to price, that one of the oldest one is among the weakest ones. And I would say that is not true. I think when you look at the standalone performance, book to price is maybe weaker than factors like EBITDA to EV or shareholder yield. But when you look at the marginal contribution in a multi-factor model where you also have quality, so items like signals like profitability or momentum in your model, then I think that book to price actually gives you the highest marginal value because it's most negatively correlated to the other factors. So I think you should not stick to the most basic book to price definition. You can also enhance it by incorporating intangibles into the signal. But I think book to price is really, in a multi-factor context, a really good signal.
What's been your most memorable investment?
The best investment, or for me, I think, was doing the PhD. So when I was a master student, I was doing several internships. I thought after my master thesis, I will go somewhere in the industry, maybe insurance, banking, asset management. Wasn't that sure which direction. But then writing my master thesis, I analyzed the former French factors for the German market. So this was my first contact with factor investing or asset pricing. And I really liked the topic. And of course, then during the PhD, broadened it, went into the international data, US data. But I think doing the PhD really helped me to think about problems, formulate them, thinking about how can I empirically test them, looking at the thoughts of others, reading their papers, and then really writing down my own thoughts. And this really helped to structure my thinking, to grow in my professional career. I think without doing this investment in the PhD, I think my career wouldn't be as it is now.
Matthias, thanks so much for joining us today.
Thanks for having me, Map.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.